Hi, it's Austin here from Beckett Employee Benefits team. Thanks for clicking on the video. A question we've been asked a lot recently is how has the coronavirus pandemic affected my pension fund? Since mid-February, the UK stock market has dropped around about 24%. Clearly this can vary from day to day. So in unsettled times, I wanted to share with you 6 key points we've been discussing with our corporate clients and their staff. The first is that most employees will be invested in the scheme's default fund. This is the one that they get put into when they automatically join their employer's pension scheme. These will be multi-asset, which means they invest some monies in stocks and shares and others in property, fixed interest and other types of investments. And generally the drop in these fund values has been a lot less than that experienced in the UK market. So whilst painful, these funds have done the job that they're designed to do. In addition, for those who are nearing retirement, there's also something called lifestyling, which has also helped in this situation. A bit more on that in a few seconds. The second point is recovery. The market expects to see a recovery. Some say it's going to be slow, some expect to see a V-shaped recovery, but regardless of the time, shape or nature, the fund manager's job during the recovery is to take advantage of the drop in prices, minimise losses where they can, and then make the most of the recovery for the risk taken. The third point, as I mentioned before, is that for those of you who are nearing retirement, lifestyling will be helping in the current situation. Lifestyling is offered on default funds and aims to reduce the risk as an individual gets closer to their retirement by changing the blend of investments. For some providers this will start 15 years from your chosen retirement, some it will be as soon as 5 years from retirement. But the blend of your investment will depend on your age, when lifestyling starts with your plan and also your selected retirement age. So now might be a good time just to go and check what your retirement age is and make sure it's aligned to when you want to retire. The fourth point is that it's a long-term investment. The average worker in the UK is around about 41. We'd expect them to retire possibly at 68. So there's a further 27 years of investment left before their retirement. Then at retirement, most employees will keep their pension funds invested and will be drawing their income out through something called drawdown. So whilst you might not want to think about it, your investment in your pension could be lasting as long as 40 years. And during that time, there will be good years and bad years. Another key concept is that it's timing the market, not timing the market. In uncertain times, it might be tempting to switch your investments out to something else that you think is lower risk. But when do you do this and when do you come out? If you don't get the timing right, you might lose the best recovery days that are available during a recovery. Studies have also shown that staying the course over the longer term is preferable. So it's timing the market, not timing the market. And the final point is keeping contributions going. Clearly circumstances may change, you may not be able to afford to make those contributions. But every time you make an investment, you are buying units in your default fund. If share prices go down, the cost of those units go down and therefore you buy more units for the same contribution. And this can have obviously long-term benefits in the longer term. Don't forget as well, you're getting your employer contribution and tax relief, and you only get those benefits if you keep your contributions going. So hopefully the points covered today will give you a broader perspective on what's happening with the pension fund. We do have a written article which we can provide for you on a PDF format if you're interested in sharing that with your employees. We're not trying to give advice in the video, so if you do need help, please speak to your advisor, or if you want to, please contact Beckett and we'd be more than happy to have a conversation with you. Thank you for listening.